Hi everyone, so on this video I'm going to help you understand why China is liberalizing its stock market and what massive impact it is going to create for investors in India, US, all across the globe. Recently you might be hearing the news that Hang Seng Index, which is one of the Chinese index, it went up in a single day by 4%. Now this is a very big move on index. Why did this happen? Why are some investors like Mr. Michael Burry are pivoting their portfolio to Chinese stocks? Can you also buy China and should you also buy Chinese market? What are the risk and reward equation there? Should you be doing it? Should you not be doing it? I'll give you a very practical perspective. Now, why practical perspective? Because for the last 8 months, I have been traveling to different parts of the world. I've spent enough time in Malaysia. I've spent enough time in Dubai, meeting a lot of investors, understanding their viewpoint on what type of international positions they are building and why. So I happen to meet a lot of Chinese investors. I'll explain their viewpoint also along this video. So 3 precise topics that we are going to cover. Number 1, I'm going to help you understand what is the new quantitative easing policy that China is adopting to liberalize its stock markets and why. Second, and more importantly, why is it that their focus is shifting from real estate to stock markets right now? And third and finally, how all this is going to impact your India stock market portfolio and US stock market portfolio, and what are some macro points that you need to understand. And just a very quick request that in case you enjoy these type of macro videos, you could consider subscribing to this channel. I teach a lot of macroeconomics, finance, investing, which is very practically driven. I'm currently managing my hedge fund. So whatever learning I get through by managing that bit of money, I bring it through my YouTube channel for everyone's benefit. So, okay, so let's start. And first and foremost, let's understand the key move that China has made. And in very simple words, what they have done is that they have instituted a $100 billion bond purchase program. In simple words, they are adding more liquidity. Liquidity means that more money will be brought into the Chinese market through this bond purchase. And as a result, because there is more money flowing into the Chinese market, what this will do is that this will push the stock prices up. This will push the other asset classes, for example, real estate and other forms of investing higher and higher. Now, this is something that we have seen in 2020 or after 2020. Quantitative easing was institutionalized by the US in 2008, in fact, when the 2008 real estate crisis broke down, and then the US government printed a lot of money and it flushed their markets with liquidity and the stock market rose quite a lot after that. The same model was adopted in 2020. Now, during that time, China was really opposed to whatever the US was doing. There were reasons why they were opposed to it. One key reason was that China was trying to take on US in terms of its economic might. China was a very fast growing economy pre-2008 and it did not want to give US all the power in terms of money printing. Okay, fine, US will print a lot of money. For the US, this will be an internal debt. But in case that money flows to China through the hedge funds in the US or through the foreign institutional investors route who will get that money in the US and will invest in China. China thought A, that it will lose control over its company, and second, it will be an external debt in a way for China. So China did not want to support the US in terms of this quantitative easing policy that the US had adopted since 2008. But in 2024, China has started to realize that they need a form of quantitative easing. That is one way of countering the growing power of the US, because in 2020, one could argue that US has literally abused the money printing system. They have injected a lot of liquidity. They have taken on a lot of internal debt, which is impacting countries all across the globe. For example, all the inflation that we see in the world, a large part of it could be credited to the US, that it is due to US money printing that India is also suffering due to high inflation. Other parts of the world are also suffering through high inflation. Even the US itself is suffering through high inflation. But in US's case, because they control this money printer, so to say, because almost 70% of the world trade happens in US dollar, because the US government gets to print the US dollar, it's easy for them to manage this internal debt because this debt is in its own currency. But for other countries, this is an external currency. So therefore, China has been very, very wary in terms of letting the US investors participate in the Chinese stock market, because wo paisa uthayenge from the US through excess money printing, bring it to China, get control over the Chinese companies. Therefore, we saw episodes of Jack Ma getting kidnapped and whatnot, which had played out in the last 2-3 years in China. So this entire background, what this has done for China is that this has pushed them to create their own money printing system, so to say. And in order to do that, Chinese government had to undertake certain steps first. And a part of this, and this is a twofold plan. The first picture you can see here that the Chinese have been able to add to their forex reserve really, really fast. This is one. And second key thing is that if you look at the speed at which they are buying physical gold, this again has been accelerated by a lot. So they are building their balance sheet, and they spent the last few years building this balance sheet to get to a point where they can actually do money printing easily. Because every time a government prints money, for example, ये तो फिर बहुत अच्छा गेम हो गया कि Indian government can come and print as much money as it like, or the Chinese government can come print as much money as it likes. But the problem in that game is the moment you print crazy amount of money, the entire world looks at you and say, hey, can you even afford to print so much money? Then you have to show the strength of your economy. And if you have enough forex reserve, enough gold reserves, etc., that acts as a counterbalancing position for this increased liquidity in the market or increased quantitative easing. So in case you are new and you're getting confused with this entire thing, here is a very quick breakup of what I wanted to cover. That A, China always mistrusted the US. They did not want to go along with the US's money printing game since 2008. In order to act as a counterbalance, they started strengthening their balance sheet, which they have already done it now. And now finally in 2024, they have started to do their own version of quantitative easing. So what does this quantitative easing means, and what was the need for China to do this quantitative easing? For this, you need to understand the mix of Chinese economy. So almost 30% of Chinese economy is dependent on real estate. And if you are a rich person in China, then one of your primary options to invest was not in the Chinese stock market, because वो बहुत cyclical होता है. You can check it from the chart here. Here's the Hang Seng Index. You can see that it is very, very cyclical. So a rich Chinese person would typically invest in real estate in China. But unfortunately, since 2021, post-COVID, the Chinese real estate market started to correct, and the property prices there have corrected. In fact, some of the biggest builders like Evergrande, they completely collapsed. And on top of that, many banks suffered and bunch of different problems happened in the Chinese real estate market. And as a result, Chinese real estate investing was not a viable option for rich investors in China anymore. So which brings me to my personal connect. Over the last few months, I have spoken with a lot of Chinese investors, and they have been looking to invest their money across real estates in Dubai, Thailand, Singapore, Malaysia. In fact, the situation is such that any market which opens up, Chinese investors are the first ones to purchase property there. This has happened in Dubai, this has happened in Thailand, this has happened in Malaysia, this is also happening in Europe as we speak. So practically what started happening is that rich people in China were left with very little options to invest anywhere, because the stocks were not moving and that was not a viable option. On top of that, real estate market had corrected. So where do rich Chinese people take their money? They wanted to invest in foreign real estate. But then the Chinese government came and imposed a ban on that as well. And the Chinese government started to realize that, hey, we want to give some kind of option to rich people here where they would feel okay putting it and they see some kind of growth potential. So opening up their stock market could be the step one in this entire game. And we are now sitting at that watershed moment. So then comes the golden question, that how all this impacts you as an end investor who is probably not investing in the Chinese market, but are probably investing your money in the Indian market or the US market. Would it have any kind of impact? Well, it will have a lot of impact on you. So take a look at this chart. You will see that China comes as a close second in terms of the economic strength in the world. And whenever any major economy decides to do quantitative easing or increase liquidity in their own local currency, it will have a domino effect all across the globe. This money will flow to different parts of the world, including that in India. And whoever is owning assets in India or in Dubai or in China or in the US or in any other part of the world, it will be a good thing for them. For example, if you own Indian real estate, will it go up? Yes, most likely it will. Bitcoin has already started shooting up. Even Indian stocks, US stocks, they will all rise. Even Chinese stocks might be sitting at that watershed moment where a lot of potential growth could come from this point on. So what are the steps that I am taking? Well, number one, I am building positions in the Chinese market. I am diverting roughly 10% of my portfolio to China. This is a long-term bet. I do see sense in the bet that the Chinese government is making. So I am building my position there. I want to be diversified. Just for context, if we actually step back and see that what has happened in the last 20 odd years, if you study the phase somewhere around 2000 to 2008, Indian markets were undervalued and the US markets were overvalued, so to say. So a lot more growth came in the Indian market compared to the US market. From 2009 all the way till 2016, 2017, it was the opposite, that the Indian market had become slightly overvalued. So not much run-up had happened in the Indian market in that phase. compared to the US market. So US market did better. Now in 2020s, we have to similarly figure out an arbitrage, and this could very well be China. I have always advocated for diversity in investment. Therefore, even I am restructuring my portfolio. Taking the Chinese bet makes a lot of sense. That's part A. Now part B, if you look at Southeast Asia, especially something like Thailand, what they have started to realize is that their population is going down, right? And as a result, they have to figure out new avenues to generate interest in their economy. Yes, with the population shrinking, the economy would not roll fast. So they want to bring interest in their stock markets also. They have started opening it up, and Chinese customers or Chinese curated customers might come to these markets also. So entire Southeast Asia looks like have understood the game that you need to democratize your market. So India was quite early in terms of doing this, so we reaped benefits. But going forward in the future, it looks like that the world is going to become multipolar. This has already started to happen, and it's important for us as investors to stay diversified. One negative repercussion of all this is, again, we can go back in history and study it, that post 2020, there was massive inflation in the economy. Countries like India got more hurt compared to US. So with Chinese doing quantitative easing, again, the inflation will keep going up in the economy. Yes, वो यार government data निकाल देते हैं, and then they say that it's only like 3% or 4%, all that stuff. But I don't think that those are true numbers, to be honest. You have to worry about your segment inflation. So inflation is going to go really, really fast. So therefore, it's absolutely critical for you to understand how to hedge your portfolio against inflation. All these points I teach in a fundamental manner on my courses, on my YouTube member community. So in case you want to learn things fundamentally from an international investing perspective, I will highly encourage you to do it. I hope you found this video to be insightful and useful. If you did, do press the like button, share it with your friends, and I'll see you soon.